So today we will be talking about a very important aspect which is on the current side, current liabilities on the financial statement, that is provisions and contingencies. So we have one very important standard on provisions and contingencies, so that we will be discussing today. And let me share with you my screen. That is provisions and contingencies under IFRS, which is covered under IAS-37. So because there are a number of provisions which are made by the business out of the profits, there are a number of contingent assets, there are a number of contingent liabilities which needs to be reflected somewhere in the financial statement, even maybe in the form of footnotes or the notes to the accounts. That is agenda of discussion today. So IAS 37 has very rightly pointed out all these issues. So this IAS 37 was released first time in September 1998. And according to the requirements, subsequent number of amendments were made in 2003, 2004, 2005, 2007, and 2008 to reflect changes in the variety of the standards, because this standard deals with the many other standards also. So therefore, whatever the changes were required in the variety of standard, that was affected through various subsequent amendments after the September 1998. So effective date of implementation as per the International Accounting Standard Board for this standard is fiscal period beginning on or after July 1, 1999. So whatever the financial statements or the accounting reports will be prepared after July 1999, so they will be preparing the concept of provisions and contingencies as per the requirements of the IAS 37. So as far as objective of this standard is concerned, this IAS 37 is to ensure that provisions, contingent liabilities, and the contingent assets are recognized based on appropriate criteria and measured using appropriate basis. So this standard prescribe you the appropriate criteria for following certain conditions. Then after that, we will be recognizing provisions, contingent liabilities, and contingent assets. And it also provide the measurements criteria, which on appropriate basis tells us how to report these transactions in the financial statements. So furthermore, this standard aim to ensure that the notes to the financial statements provide sufficient information so that the users can understand the nature of these assets, timing, and amount of any provisions, maybe current liabilities and contingent assets. So the key underlying principle is that provision should be recognized only when liability exists. If there is no liability exists, provision should not be made in the financial statements. Accordingly, if you have planned certain expenditure but still has not spent anything, so no provision for such kind of things should be made. So even if the board of directors has authorized the board of directors has authorized the accounting experts to deal with. So unless and until you have spent something or there is a certainty that such certain kind of losses are going to occur, you will not make any kind of provisions. So as far as the scope of this IAS 37 is concerned, basically it deals with the provision, contingent liabilities, and contingent assets, but it does not deal with the two categories. This will be out of the scope of these provisions and contingent liabilities and contingent assets. So we'll be dealing with two kind of things. Number one, it will be if item arising from non-onerous executory contracts are concerned. So it will deal with only executory contracts. So provisions, contingent assets, and contingent liabilities will be reflected in the financial statement if they are arising from onerous executory contract. If they are arising from non-onerous executory contracts, it will not be followed. So what is executory contract? Executory contract is one where neither party to the contract has performed any of their obligations. Still it is under obligation to participate in, or where both the parties has performed a portion of their obligation to an equal extent. That applies to executory contract only if the contract is onerous. Onerous means that the unavoidable cost of fulfilling the contract or exiting it from it exceed the economic benefits expected to be received under it. Suppose you have performed something in an executory contract and you have spent something or you are supposed to spend something in future, then it will be reported in the financial statements. If it is non-onerous, it means there is no unavoidable cost of fulfilling the contract or exiting it from the contract, will not have any loss to the organization or will have to spend something by the organization, then it will not be reported. So item arising from non-onerous. Non-onerous mean where no unavoidable cost is there. If it is unavoidable cost is there, that is onerous. So executory mean something, either nothing has been performed by the various parties or has been performed part by the various parties, only then this will be treated as onerous contract. So this will be obligation only executory. As far as the executory non-onerous contracts are concerned, that will not be applicable by IAS 37. Secondly, there are certain things which are covered by the other standard, like other in the previous also we have seen that some of the provisions are made in other standard. Uh, for example, some time of provisions are addressed in IAS 11, that is construction contracts. Some are reflected in IAS 12, that is income taxes. IAS 17 that relates to leases, IAS 19 that is concerned with the employee benefits. In addition, these standards do not apply to the financial statements that are covered under IAS 39, that is financial instruments, recognition and measurement. Finally, IAS 37 does not cover provisions, contingent liabilities and contingent assets arising from insurance contracts that is covered under IFRS 4, but it does deal with the provision, contingent liabilities and contingent assets of the insurer. So where other standards are there for dealing with such kind of transaction, for example, in case of construction contracts, income taxes, leases, employee benefits, financial instruments, insurance contracts. So this IAS 37 will not be applicable there. So in two cases, IAS 37 will not be applicable. Number one, item arising for non-onerous executory contract. Non-onerous executory contracts mean there is no unavoidable cost, or by exiting it, nothing is going to happen to you. Then IAS 37 will not be applicable. And if something is covered by other standard like IAS 11, IAS 12, IAS 17, IAS 19, IAS 39, or IFRS 4, then again IAS 37 will not be applicable. So these are the exception where IAS 37 will not be applicable. In all other cases where onerous executory contracts are there, then this IAS 37 will be applicable. There are certain definitions which are given under IAS 37, which include: number one is a constructive obligation. A constructive obligation is an obligation that derives from the entity's actions, where by established pattern of past practices or published policies or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. If your past practices, if your published documents or certain statements indicate that you have to incur certain responsibilities towards other, that is called constructive obligation. Similarly, as a result of the entity has created a valid expectation on the part of those other parties that it will discharge certain responsibilities. If due to these your actions, it has been established that you will have to pay something to others and other parties has relied on it, then it is a constructive obligation on your part. Second is, we have used the term contingent assets, contingent liabilities, provisions. So contingent asset, what is contingent asset? Contingent asset is a possible asset that arise from the past event and whose existence will be confirmed by the occurrence or non-occurrence of the future events, not wholly within the control of the entity. For example, you have some building, but the court case is going on. So court case is going on from the past, but its decision will be held in the future. So the asset is there, but its ownership will be decided in the future by the court. So if something happen and that kind of asset is there, that is called contingent asset. Similarly, there is a term contingent liability. Contingent liability, same way, a possible obligation that arise from the past event and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Similarly, for example, if you have some obligation but the court case is going on, presently you have nothing to pay, but in future, if that court case goes against you, then you have to pay something. That is a contingent liability. Similarly, a present obligation may be there that arises from the past, but it is not recognized yet because it is not probable that outflow of resources embodying economic benefits will be required to settle in the future. You don't know whether you have to pay or whether you don't have to pay, but a past obligation is there. So the amount of obligation presently cannot be made with sufficient reliability. If some court case is going on, it is settled in the future, then the liability may arise. So such kind of things are known as contingent liabilities. Then there is another term, an obligating event. An obligating event is an event that creates a legal or constructive obligation that results in entity having no realistic alternative to settling the obligation. For example, court imposes fine on you. The matter is going on in the past, but it was not settled. It was not there that you have to pay something, but in future some event happened and then you have to pay the fine for that. That is not in your hand to avoid this. So that event, if it imposes some obligation on you, some liability on you, and it creates a legal or constructive obligation on you, that is called obligating event. So similarly, a term provision. Provision is a liability of uncertain timing or amount. We don't know, but we know that some loss is going to be there. But as far as the real kind of thing is there, how much loss is going to be there, at what time it is going to be there, that we don't know. So provisions are distinguished from accrual. Something is accrue, some expenditure accrue but do not pay. So that is not a provision. That is a realistic amount of expenditure you have to make in future. So that is your liability, clear-cut liability. So it will come in the current liability concept. So as far as the provisions are concerned, provisions are distinguished from accrual because although both may require estimates, that is much less uncertainty with accrual with the provisions. But as far as accruals are concerned, there is a lesser uncertainty. But as far as provisions are concerned, we made provisions because we are totally uncertain about it. We don't know whether actual amount will be, what actual amount will be paid by this. So these are some definitions which are given in the para 10 of the IAS 37. Next part is how to recognize provisions and contingencies. So IAS 37 prohibits the recognition of contingent assets unless it actually arises. It is not going to be recognized. So based on the perspective that including a contingent asset on the balance sheet might result in recognition of some income that is never realized. However, if an inflow of economic benefit is probable, that is more or likely not, the contingent asset should be disclosed. So note that if inflow of economic benefit is virtually certain, then the related asset is not contingent asset. If the economic benefit in future is uncertain, then it is contingent asset, and even on occurring, therefore it should be recognized. If it is certain that some economic benefit is going to be there, there is no going to be uncertainty, then it should be recognized an asset. If there is uncertainty, then it is a contingent asset. Contingent asset should not be recognized in the financial statements, but they can be given explanation in the notes to the accounts. So this is one thing which is regarding the contingent assets. Similarly, regarding the contingent liabilities are also not recognized in the financial statement, but they must be disclosed unless the possibility of outflow of economic resources is remote. If it is not possible that we will have certain kind of foregone of economic resources in the future, then it should not be recognized. But if it is there that some possibility is there, it should be explained in the notes to the accounts. But if it is certain to pay something, it is not contingent liability. So contingent liability should be continually monitored, and if the outflow of resources become probable, they should be recognized as a provision. So contingent liabilities if there is a provision, there is a possibility of certainty of loss, then you should make a provision. Otherwise, you should show it in the notes to the accounts. Third thing is provisions. A provision is recognized in the financial statement when number three things are there. Number one, an entity has a present obligation as a result of the past event. Number two, it is probable that outflow of economic resources will be required to settle that obligation. Third, the amount of obligation can be reliably estimated. Now, three things are there. Number one is contingent asset, no reporting. No reporting in the financial statement. It will not be included in the financial statement like comprehensive income or the statement of financial position, but in notes to the account. Similarly, contingent liability, it will also be reported in the notes to the account. But as far as the provision is concerned, it is obligation because of the past event. It is probable that future economic outflow will be here, and it is possible to measure that economic obligation. Then you will definitely make provision in the financial statement itself and show in the statement of financial position. So note from the definition of contingent liability that if an item meets the first criteria of recognition as provision but does not meet the second criteria, is treated as contingent liability. So if all the three conditions are fulfilled, then it will be a provision. If all the three conditions are not fulfilled, only first is there, then it is a contingent liability or contingent asset. So accordingly, we will make insertion in the notes to the account. So when a provision is recognized, the debit side of the entry is always an expense. Naturally, when you make a provision, so you will charge to the income statement. So you will recognize. Similarly, if provision is there, then some amount may be as debited to the asset account. For example, provision for depreciation is created. You will deduct it from the that particular asset, or you may show it on the liability side. So in determining whether a provision should be recognized, the present obligation does not need to be a legal obligation. Constructive obligation may also give rise to the provision if either two criteria are met. In rare cases, such as some lawsuits, it may not be clear whether a present obligation exists. Accordingly, a provision is recognized if the outflow of economic benefit is likely than not. If this test is not met, this would be treated as a contingent liability. If it is likely that something is going to be paid by you, then you can make a provision. Otherwise, it will be shown as contingent liability. So IAS-37 clearly states that no provision is recognized for future operating losses for costs that need to be incurred or to be operated in future. So in future, if you have to pay certain amount of things, not because of the past events, so it will not be reported. So financial statements represent the financial position of the company at the end of the operating period, and it is not possible position in the future. So therefore, IAS-37 provide the these kind of things. So there are certain provisions for presentation and disclosures of provisions of contingent provisions and contingent assets and contingent liabilities. So what things should be disclosed here for provision? It is absolutely stated that you will show the operating carrying amount, you will show the additions during the period, including the increases to existing provision. You will show the amount charged against provision during the period, unused amount reversed during the period, or unwinding of the discount that is increased during the period in the discount account arising from the passage of time and with effect of any change in the discount rate. Similarly, closing carrying amount you will show. So here comparative information is not required for these reconciliations. So in addition, for each class of provision, the entity is required to disclose a brief description about the nature and obligation and the expected timing of any resulting outflow. Similarly, you will show an indication of uncertainties surrounding the amount or timing of the outflow, the major assumptions which has been made concerning any future events. They are reflected in the regular amount of provision because their expected impact on the amount required to settle an obligation. So information on any expected reimbursement that need to be. Similarly, regarding the contingent liabilities, unless possibility of any outflow is settlement is remote, then entity is required to provide brief description of the nature of such kind of each class of contingent liability should be there. So the estimate of financial effect kitna ho sakta hai, an indication of uncertain surroundings or the possibility of partial or full reimbursement from any party. Similarly, the contingent assets, if the inflow of the economic benefit is possible, the entity should provide a brief description of the nature of the contingent assets. So, but it will not be reflected in the statement of financial position or statement of comprehensive income. So, using the all these things, you will explain all these things in the notes to the account. So, this was all regarding the IAS 37, which deals with the provisions for contingent assets and provisions, contingent assets, and contingent liabilities. So, three things are there. If it is certain that certain kind of loss is going to be occur, certain inflows are can be measured accurately, then it is provisions. Otherwise, it is treated as current contingent liabilities. If some contingent asset is going to be happen, then we will not make entry into the statement of financial position, but in the notes to the accounts, if possible, some insertions can be given. So this was all regarding this. Now you can on your videos and you may raise your queries, if any. So very, very small standard, IAS 37, which absolutely disclose the provisions, contingent assets and contingent liabilities. Any question from your side?
सर
बोलो
सर हमने स्कोप में किया था, मतलब 2 आइटम्स हैं जो हम कवर नहीं करते IAS 37 में। जो उसकी सेकंड आइटम थी, आइटम्स कवर्ड बाय अनदर स्टैंडर्ड, उसमें था इंश्योरेंस कॉन्ट्रैक्ट। फिर लास्ट लाइन में ये भी लिखा हुआ था IAS 37 deals with insurer.
Insurance contract, if some obligation on the part of the insured is there, that is to be covered under this. So that, because that we don't have to disclose, but the other party need some kind of things. For example, read it again. It is written that IAS 37 does not cover provision, contingent liabilities and contingent assets arising from insurance contracts because it deals with the IFRS 4. But it does deal the provisions, contingent liabilities and contingent assets of the insurer. Insurer, unless these elements arise from contractual obligations and rights under insurance contracts within the scope. If the contingent assets, contingent liabilities, and provisions are not covered under the insurance contracts, if it is covered under insurance contract, we have IFRS 4. If it is not covered under insurance contract, but because of some other reasons, some obligations arise, that will be covered under IAS 37. IAS 37.
Okay, sir. एंड सर वो भी नहीं समझ में आया, नॉन ऑनरस एग्जीक्यूटिव ऑब्लिगेशन।
Onerous obligation, onerous contract is that contract where the cost of fulfilling the contract or exiting from the contract is unavoidable. So it is onerous when cost of exiting from the contract or cost of operation of the contract is unavoidable. So you cannot avoid the cost. But if it is avoidable, that becomes the non-onerous executory contract. So in case of onerous executory contracts, this IAS 37 will be applicable. For other kinds of non-onerous executory contracts, this IAS 37 will not be applicable. Onerous here means unavoidable. That means the cost of fulfilling the contract is unavoidable. Or if you exit from the contract, even then your cost is going to be higher than the economic benefits which you are going to receive. So if it is unavoidable and if it is certain that you have to pay something exceeding the economic benefits, it is onerous. And in case of onerous, only IAS 37 is applicable. For non-onerous, that means where avoidable costs are there, you can avoid the cost, or you are not going to have any loss by exiting from the contract. At that place, IAS 37 is not applicable.
Yes, sir.
You follow this point or not?
Yes,
You
sir.
have to read again
Now,
and again to get the clarification. If,
yes,
then you
sir.
will be benefited. Yes. Any other? So, okay, all the best. Now we'll meet on Monday with the next uh,